Okay, let me move us out of the way.
I think the most depressing thing about tonight's webinar, State of the Markets 2023, is everything we predicted in 2022 came true, and then some worse.
Yeah, we were unfortunately very correct about last year.
Although it did not take a genius, pretty much anybody could figure out.
Yeah, I was going to say it was not hard to read the writing on the wall to see what direction we were headed in. It was only a matter of time before we hit it.
But the good news is we're still not in a recession, according to Powell.
We're going to talk about that tonight. So, with that being said, thank y'all for joining us. This is our 2023 State of the Market. So, with that, we will jump right in. So, agenda for tonight. In memoriam 2022, I think is a perfect way to put it. We're going to cover everything that happened in 2022, things that symbolically died as of 2022. Look forward to 2023, 5 big questions that investors have this year and things to kind of keep in mind. And then last but not least, portfolio positioning. How should you be positioned as a result of last year and to take advantage of what we think is going to happen this year? So
let's talk about the things we're going to miss in 2022 or that died in 2022. All right. For the first time since 2008, 2009, those of you that are old enough, that was the last market disaster. Central banks have turned hawkish and are beginning fighting inflation. Now, what that means is instead of fueling the economy, they are deliberately trying to slow the economy down, which is how you fight inflation. To George's generation, this is a brand new thing. I mean, this generation has never seen interest rates like this. They've never seen prices go up like this. It's like a cold shoot.
It's uncharted waters for people like me that are that are pretty young. I mean, I was alive in 2008, but was too young for it to have mattered to me. I think I was more aware of it than most because of what he does for a living. And so I heard a little bit about it just kind of in passing, but this is the first time in my working adult lifetime that I've ever encountered something like this.
Yeah. All right, so we're going to commemorate the lost icons of 2022.
Yeah, the example that was given were people like Queen Elizabeth and others, but that's not what we're talking about tonight.
Nope, we're talking about financial icons.
Yes. There we go.
All right, zero interest rate policy. Gone.
Dead. Yep, dead and gone.
I personally think that's a good thing. I think when the feds have the central bank at zero, no one can make money. George, again, has a heart attack. But I know most of you probably remember back when I was a kid growing up, a normal mortgage was 4.5%, 5%, 6%. That was not considered to be an outrageous mortgage. And I think we're heading back to those days. I think you're going to see a prime, once this settles down, a prime probably in the 2 to 3% range, which is going to give you a mortgage of 5 to 6.
Yeah. And again, the most important thing here is the 0% rates were just not sustainable. It's great for the consumer, you and I, but that's not sustainable for an economy. And as we're feeling the effects of that right now.
It's probably the biggest one the Fed put, and we've talked about this with most of y'all since you're clients of ours. Since really Barack Obama, the Feds have consistently stepped in when the market went bad by buying billions and trillions of dollars of bonds, among other things. President Biden announced at the end of 2021 that they would no longer do that beginning in 2022. And that's exactly what happened. And so that's one of the big reasons why the markets just dropped like stones. So the market is now aware that the Fed's not going to prop them up anymore. Now, again, my personal opinion, personal and professional opinion is this is a good thing because I think it will get us, as painful as it is, I think it will get us out of the ridiculously high markets that we really shouldn't be at. And I think we're going to see some market adjustments that bring the market down to what it should be, not to what it's artificially propped up as.
Yeah, I was going to say, I don't think that the markets dropped. I mean, they dropped, but I don't think it was a true loss. I think this was more of a correction that we were like you said, artificially propped up. And what we felt last year was sort of a correction. I mean, it was a recession, but also a correction back towards normalcy, back to where we really ought to be as a stock market.
But having said that, presidential election coming up. Would not surprise me a bit in the world if the government stepped back in and propped the markets up again, because obviously the Democrats want to stay in power. That's normal. And the best way to do that is to make people think we got a great economy. So it would not surprise me to see this happen again, primarily 2024. Yeah, just in time for the presidential election. There is no alternative. Everyone has had to invest in risky securities because the non-risky securities were paying nothing.
Yeah.
So we have had probably the most common question we've had in the last 12, 14 months is, I got $100,000. Where can I put it that's safe and guaranteed and I get my hands on it any time?
Nowhere.
And there is nowhere to do that. Now, having said that, one of the things we have seen recently, there are some excellent online savings accounts that are actually paying 3.25%, 3.5% interest. It is a true savings account, no fees, no minimum, no limit as to how your money comes and goes. We won't tell you who they are on this, but if you give us a call if you want to. Now, this is not anything that we represent, but it's stuff that we personally use ourselves. So you can get a really good savings account, money market account right now, paying 3.5% is what it is today, 3.5% interest. You can put the money in today and get it back out tomorrow. No questions, no problems, no issues. So those of you that have substantial amount of money in money markets that are making a whopping 0.5%, I would encourage you to look into that.
Yeah, but this was probably one of the most damaging things last year was there was, and we'll talk more about this in just a second, there was nowhere you could put your money to be safe because you were either not gaining anything or losing money to inflation, or you were taking a hit because you're in the market. There was truly nowhere to hide. Everything took a hit. When we're just now starting to see bond issuers and things like that start to respond to these high interest rates. And so we'll talk more about that as we go.
One more thing too, but having said that, the vast majority of you, if you've worked with us, we have accommodated the lack of small returns. And I know that a lot of you keep significant amounts of cash in the bank, and it is just driving you crazy that you're not getting paid any interest on it. But in the long run, that does not affect your financial future or your portfolio. It does hurt your heart. But if you're making 0.5% or 3% on $50,000, that is not going to impact you. It's more of an emotional feel-good thing more than anything else. So that truly is, it's a frustrating thing for us professionally, because people really get upset about these low interest, well, what were low interest, well, still low interest rates.
Yeah.
But it really doesn't matter unless you've got, the majority of your wealth in a money market account.
Yep. So like we were talking about, 2022 was the year that diversification just collapsed. There was absolutely nowhere to hide, nowhere to put your money to avoid losses. The only sector that was up last year was commodities, and that was just because of the supply chain issues. I mean, oil skyrocketed because you couldn't get it anywhere.
Yeah.
I mean, you can see across the board.
Oh my goodness, is that gold down?
Gold is down. Yes,
that's impossible.
I know. It's supposed to be, well, yeah. Treasury bonds, stocks across the board took a massive hit. Again, there was just nowhere to hide because most people had to have their money in these things in order to make putting their money anywhere worthwhile.
Yeah. So those of you that really got upset with us last year because we had losing portfolios, this is everything why, not being sarcastic, but this is why.
Yeah.
There was nowhere to go to get a positive return.
Yep.
If you'll notice, even middle of the graph, even the international stuff down, emerging markets down. There's nothing that was up last year.
Yep. So nowhere to hide. All right, looking forward to 2023, what are the 5 big questions that we're looking to answer this year? First one, will inflation continue to subside? According to this graph, inflation has already taken a big fall.
Unless you're buying eggs.
Yeah, I don't necessarily agree with this. Inflation is high. There's no doubt about that. I don't think anyone can argue with that. Not only is it high, it is deep. It is entrenched in the economy because of the Fed's inaction for so long. They let inflation get a really solid foothold. And so it's going to take a long time to dig it out. I mean, it's got its roots deep. Some of the reports are estimating that inflation will ease by the end of this year. I don't know that that's going to happen. If it does ease, it'll be very mild. It won't be it will probably be unnoticeable. But overall, we're not expecting any big swings one way or the other this year.
My fear too is that, again, because of the presidential election coming up, that they will do some ridiculous political moves at the end of this year, which will make the economy look good for about 18 months, but will exacerbate the inflation and start this vicious cycle all over again. Unfortunately, politics really runs our economy now, and that's just the way it is.
Yep.
All right, can banks manage a soft landing? This is kind of, when banks raise interest rates, and we're talking about the Federal Reserve Bank, it takes a while for the interest rates to have an impact. And so a soft landing, meaning they raise it just enough to cut inflation, to cut inflation, but not totally destroy the economy. And that's a great quote. Raising interest rates, drinking hard liquor. By the time you feel the effects, you may already be wasted. So the real question is, can they do a soft landing? Can they raise the rates high enough to stop this inflation, but not so high that it wipes out the economy? Now, right now, there's more fear about a recession than there is about inflationary rate. Alpha Star, who is the people we use for our statistical data, our research,
they're the ones that compiled all this data tonight.
They feel there will be no global recession in 2023. They think there'll be a recession in Europe and either a very shallow one or no recession in the United States. I vehemently disagree. I think with the recession conversation, we have fallen into they have fallen into the uncomfortable, or I think risky position of going, if it's got to meet this exact formula and criteria for us to call it a recession, as opposed to just looking at the economy and saying, whoa, everything slowed down. So I don't agree. I think we're already in a recession.
I was going to say, their view is that there won't be a recession in 2023. And I agree with that because we're already in one.
Yeah,
there's not going to be one forming this year because we're already in one. We're probably towards the tail end of one, honestly. I mean, we've been in.
Again, it's in their best interest to say we're not in a recession. We're not in a recession. So that's what's happening.
Yep. All right. Big thing here. This is the one bright shining star in the economy right now.
And this could be the reason if we avoid a recession.
Yeah, this could be one of the biggest reasons. The labor market. We have low unemployment and plenty of job openings. So right now, a lot of companies can't fill the positions that they have available because there's too many jobs and not enough people not working. So we're at a time in our labor market where if you want to work, you can get a job. There's jobs everywhere. That is wind in the sails of an economy. If unemployment is low, you keep the labor market strong. That increases production, manufacturing, things like that. That's what keeps an economy going. And so that could be kind of the counterweight to all of these interest rate hikes is to kind of keep the scale balanced instead of going too far in one direction. It's hard to tell right now. Our current unemployment rate is, as you can see, 3.5%, which is, pretty good. So this could be the one shining star this year that we see that will keep us out of a recession or help to bring us out of one, depending on who you ask.
All right, here's the big one, mortgage rates. Mortgage rates obviously doubled in 2022 because the Central Reserve Bank, jacked up the prime interest rates. Now, this is good because we've seen the housing prices are beyond absurd. I mean, we're here in Greenville last year. If you were looking to buy a $200,000 house, you could expect to pay $250,000 to $275,000. And then when the mortgage rates went up, of course, that caused us the housing market to correct. And now a $200,000 house is probably still 2.25, but it's not as bad as it was. So we think that the rates are going to stay high for a while. The prices are going to come back down to what is a reasonable price. And so we see this as a good correction, not a crash. And we see a lot of people bought housing during the zero interest rates that probably couldn't afford what they did. And unfortunately, a lot of them bought them with bearable loans. And so I think we're going to see a lot of
a glut of inventory,
a lot of big toys on the market, a lot of houses, a lot of motorcycles, boats, cars, trucks, that kind of thing. So, and this is all a correction. I mean, it sounds bad to say this, but there are some people, because of economic circumstances, that just shouldn't have a $500,000 house. But during 0% interest rates, they were buying them. And now kind of that chicken's kind of come home to roost now.
Yep. Another big one, geopolitics driving the markets. Obviously, politics around the world has a huge impact on the world market, especially ours. China has changed their COVID policies. Since COVID hit, they have had a zero COVID policy. And what that means is that their whole strategy behind combating COVID was not allowing COVID anywhere in their country. They were shutting down whole cities and whole counties if there was one case of COVID to try and stop the spread. Whether that's a good or a bad thing, we're not here to say that. But what that does mean is now that they're switching from that zero COVID policy, they're kind of backing down off of that. That'll have a huge impact on global growth. Their growth rate, I looked up today, they were shooting for 5.5% of their GDP last year. As of September, they were only at 3.9%. If they can hit their goal for that this year, that will help drive markets up around the world, because China is one of the biggest manufacturers for a lot of things that countries around the world need. And so if they can get back to a sense of normalcy with manufacturing, that'll help drive the market up. So this, along with everything else we've been talking about over the last few minutes, these 5 questions, all of these are going to play into what's going to happen with the markets this year, depending on which way they go. So it's not any one factor that's going to drive a market up or down.
Question for 2023, will inflation continue to subside? I think it will, not dramatically, but I think it will. Will central banks over tighten? I believe they will. I believe you'll see at least one more, if not 2 more increases of a quarter of a point. So I think we'll go up another half point. I think the labor market's going to hold up fine. And I know I'm negative Nelly here, but a lot of the labor market, really good statistical data is people coming back to work after COVID. So it's not that it's this booming labor market, it's just it's coming back to normal, and compared to the COVID years, it looks fantastic. I think housing prices will continue to fall because I think the interest rate will continue to rise. Geopolitics is actually my biggest concern. I think there's a very real chance that there will be a significant armed conflict in the next 5 years with China in the middle of it. I personally believe it's just a matter of time before they move on Taiwan and take Taiwan. And whether or not the United States interferes with that, who knows? But I do think that has the capacity to be, if not a world war, pretty close to it. Also have some significant concerns about Russia, or the Soviet Union, whatever you want to call them. Their little foray into Ukraine, thank you, is becoming enormously expensive, and they're going to have to start taking some things to keep things going. So those are my 2 big concerns with geopolitics, not whether China will hit their industrial thing, but what's going to happen with the industrial target, but what's going to happen with the Soviet Union and with China and world politics in general. Sometimes war is good for an economy, sometimes not. I think a lot depends upon how the United States and its allies respond to
whatever happens.
Yeah, whatever happens.
Yeah. So one good thing to monitor, the supply chains and manufacturing and inflation. The consumer price index, energy costs, and housing prices all declined towards the end of 2022. I don't know about the CPI. I wasn't aware that the CPI is the measure of inflation. A little bit surprising to hear that the index went down.
It must have been measuring something I don't buy.
Yeah, because the consumer price index is measuring prices that we pay as consumers. I didn't see anything drop towards the end of the year. I'm not really sure where that data is coming from, but we could see a positive surprise this year as supply chain bottlenecks continue to open up. We continue to have an easing of the labor market that could relieve some of the wage pressure. One of the things that we've seen over the last few years is companies have had to pay their workers a lot more because of the lack of workers. Because there weren't people working, they had to pay people a lot more. There was a lot of wage pressure to be competitive, to kind of draw people into work. And again, as prices continue to rise, people are buying less and less things, which means that the supply chain can finally catch up. Some of these bottlenecks are opening. We're getting things that we need to manufacture things. So All of these things combined could lead to a drop in inflation this year. I don't believe it's going to be, we don't believe it's going to be anything super dramatic, but these are all of the ingredients that you need to decrease inflation and to come out of this.
I think the beginning of the healing is starting with the supply chain opening back up. You're going to start seeing instead of you're going to start seeing a surplus of things instead of not enough stuff,
which means prices are going to come down.
Prices are going to come down. Yep. So yeah, I really think in this case, what's going to help the inflationary rate is not the Federal Reserve Board and their interest rates, but the fact that people are going back to work, we're able to get raw goods into the factories, and you're going to start seeing a surplus of goods as opposed to a negative goods, and that's going to bring it down. Now, how dramatic will it be? George said, I don't think it'll be very dramatic, but I do think by this summer you're going to feel a difference to the good. Yeah. Again, a lot depends upon what the Federal Reserve Board does with their interest rates, but statistically, I can see things getting better in 6 months. That does not mean we see a wholesome, robust stock market in 6 months, but it means just the beginning of things like that.
And I think the supply chain is probably the biggest thing. We've had supply chain issues for, I mean, everybody knows if you've been trying to buy any big ticket items, or I mean, even normal stuff, it's either really hard to get or it's super, super expensive. The fact that these bottlenecks are finally opening up and things are making their way back into the country, that we can build stuff, manufacture these things, is huge because it's giving these companies time to catch their breath and get caught up again, which will lead to a surplus, which just leads to prices dropping. So all of this could be the perfect recipe for what we need.
Yeah, you're already starting to see car lots fill back up with cars. That's a great example.
That's the perfect example. Yeah. Exactly.
Yeah.
Yep.
All right. Now, here's things interesting though. There are a lot of companies that were very profitable because low interest rates were around, and they're not going to be profitable with high interest rates. So I think you're going to see a lot of defaults in a lot of companies. Again, this sounds harsh. I don't mean it to, but kind of law of the jungle is, if you're only profitable when there's an artificial interest rate or artificial stock market, then you're not really profitable. So what we're going to see is some companies that go under because they can't take advantage of the 0s and 1% rates. When the Fed brought their PPP money out, when they bought their COVID money out, that gave some life for another couple of years. But I think you're going to see some companies go under that are going to surprise you, that had a very narrow margin of profit. Do I think it'll impact the stock market? Not so much. I think these are companies that don't really play that well in the big sector.
Yeah, because again, this sounds harsh, but if the companies can't survive during a high inflation time, a high interest rate environment, they weren't going to make it. I mean, if the only time that they can thrive and survive is during a low interest rate, zero interest rate environment, they weren't really set up for success to begin with. So this is certainly something negative to monitor, but we don't really think it's going to be something that's going to tip the scale one way or the other.
All right, portfolio position. So to sum it up, we got hawkish central banks. In other words, the banks are more interested in slowing the economy down than feeding the economy. We have recession, which is scaring the blue blood out of everybody as opposed to inflation. Potential for Europe to have a recession, either a mild recession or no recession for us. I would recategorize that as we're going to come out of a recession. The China slowdown, sluggish GDP growth, and rocky geopolitics. To me, guys, this is what it's been every year since I've been a financial planner. The only difference is this time, or this point in time, we have the inflation fears.
I was going to say, I think
but it's always been rocky geopolitics.
I think right now you have a combination of everything on this list, as opposed to maybe 3 or 4 of them at any given time in any given year. You know, right now all of this stuff is in play, as opposed to just geopolitics and hawkish bank or something like that.
Yeah, because I guess because of my age, this stuff doesn't cause me a great stir because I've seen it before. 2008, when I was in college, 1978, 1982, interest rates were 18%. I mean, we've been here, we've done all this before. You know, my boy George here, he's like a culture shock to him because he's never seen this kind of stuff before, but the vast majority of us have. And if you read hawkish central banks, recession, mild recession, China slowdown, sluggish growth, rocky geopolitics, that's the headlines you've seen for the last 20 years in the newspapers. So I just don't see anything that dramatic happening. I think a slow easing out of what I think is a recession. I think the markets will slowly recover. Do not think they will come back to a 35 or 36,000. Could be wrong, but I don't think so. And I think we're gonna have to get used to a prime rate being 2.5%.
Yeah. All right, kind of the investment environment that we're expecting to have this year. Choppy first half. We're kind of seeing that right now. Choppy meaning up one day, down the next, up one day, down the next. Not really doing anything either direction. Pretty sideways. We're going to have some weakness before we start recovering. Again, we're feeling that right now, where it may be up 250 points today and it might drop 300 tomorrow. Again, kind of what you can expect. We do think you are going to start seeing those diversification benefits come back, and you've already seen that even in the first couple of months this year. The market has been I'm sure your portfolios have recovered pretty nicely over the last few months. So
yeah, the last 2 months.
Yeah, the last 2 months. So having that diversification, now you're going to be reaping the benefits of staying in the market and not having that knee-jerk reaction to a bad market. You guys are going to come out on top, as opposed to the people that got out and are trying to get back in when they think the time is right. And last but not least, a defensive posture, kind of a total pivot of where we were a couple of years ago. Value over growth, international over US. What you need to be aware of here is that if you're working with us, all of these things are represented in your portfolio and have been even last year.
Since you bought the portfolio.
Yeah, I mean, nothing has changed since last year happened. We haven't made any changes to our investment philosophy, haven't recommended anybody make any changes. We're doing the same thing that we've always done, and that kind of leads into this.
All right, so remember, build your core portfolio for the long term. And this sounds self-gratifying, but what we recommend to everybody is always a core portfolio. Whether you're a young buck like George and have a 70-30, whether you're an old coot like me and have a 50-50, they're core portfolios. Core meaning that they cover all the different sectors in the stock market. It's about time in the market, not timing. Many of you have called and said, hey, shouldn't I get out and get back in? There is no data anywhere ever that says that's the thing to do. Ride the market out. As you get closer to retirement, if you're a client of ours, we're going to pull you out of some of it. So we're going to protect you from a market crash by limiting your exposure, not by buying and selling new stuff. Asset allocation, far more important than security selection. You're much better off being in a widely diversified portfolio than picking the right stock. Remember that our portfolios have between 9,000 and 12,000 different stocks in them. So you have pretty much got the entire market covered. Control the controllables. You know, we're going to tell you expenses. The average portfolio out there, if you're a retail portfolio, 2.5% to 4%. The most expensive portfolio that we have known to mankind is 1.14. So a retail portfolio has to beat our portfolios, and not because George and I are geniuses, but because of who we work with.
Well, there is that too.
Well, there's that too.
Yeah.
But a normal retail portfolio has to outperform ours by 2 or 3% to break even because of the expenses. And remember, there are some trade-offs. If you want certainty and liquidity, you're going to get very low returns right now. I can give you liquidity with a low return. I can give you certain with a high return, but no liquidity. Long-term prosperity comes from long-term stock investing. There is no such thing as a free lunch, and y'all know this, but you got to put the money up, let it work, let compound interest be your friend. Remember, over a 10-year cycle in the stock market, it's always been this way. You have 2 good years, 2 bad years, 6 okay years. We're going for the 6 okay years. We're not going for a 12 or 14% home run. We're going for a solid 7 or 8%, because that's what the market can do. The market averages about 8.5% over your lifetime. And those of you that we've done the full-scale financial plan for you, remember that we use a 6% factor. So we're actually more conservative than what the stock market does. But time is your friend in this. Do not jump in and out. All that does is cost you money.
Yep. And that is all we got. I think now, disclosures. These are just data, more disclosures, definitions, blah, blah, blah. And now we're going to take some time for questions. So we'll hang out here for a little bit. If y'all have any questions, fire away and we will talk about them.
Yep. And I'm gonna have a swallow of Pepsi.
Yeah.
It has been a long day, by the way, so don't make anything complicated, Neil. Okay, well, no questions.
Yeah. Maybe they all fell asleep.
They probably all left.
Well,
Is anybody still there?
oh yeah.
Oh, okay. How can you tell?
Oh, we got a question.
Oh,
No questions. Oh, well, I mean, you know.
buying luxury items. I'm not sure, Lily, I'm not sure I understand I'm not sure I understand the question. Can you
Yeah,
discuss buying luxury items? You mean, I guess or maybe you're saying, oh, this cars and watches. Got it. I know this is coming from now. If you are if you're a highly paid physician that resides in Nevada, this is an excellent time to purchase cars and watches. Is that what you want me to say, Lily? We have one of our clients that collects watches and to a certain extent collect cars. And
She says stop feeding the monster.
And
That
yes,
was the wrong answer.
yes,
Yeah.
and obviously his wife is inquiring, isn't this a bad time to buy watches and cars? And theoretically, it's a bad time to buy anything if you're looking for an investable asset like a watch or a car, because prices are high right now. So Alvin, stop that immediately. I lied. Okay, Neil's back. Yeah, Neil's question is, he's got some significant assets in a money market account. He said, should I call you and find out where to put it? If you want to keep it liquid and you want to get a good return, then give us a call and we'll tell you about these online bank accounts. Again, this is not something that we represent, but it's a great investment at 3.5%. And you could literally put the money in tomorrow morning and tomorrow afternoon, get it back out. There's no restrictions, no anything. These electronic banks are doing a fantastic job because they're inexpensive. Essentially what they do is they will electronically link to your checking account, and that way you can transfer money back and forth.
Yeah, right now that's the best place to put like bank money, because the market is still so flaky and still kind of weak. Don't really know what's going to happen in the short term. Something like this is a great place to put it. Got another question about if these banks are all secure.
They're all FDIC.
Yeah, all FDIC insured,
Yeah.
all with reputable companies. Like if again, we're not going to say any names here, but if we named off a couple, you would recognize them.
These are just the banks realizing that they can pay a decent interest rate if they cut the big buildings out and the tellers out and that kind of thing. And really and truly, like I said, it takes about 5 minutes to set up an account. You electronically link, your checking account or savings account to it. And you basically go online and say, hey, transfer X amount of dollars to my online savings account. When you want the money back, bring it back. And it takes about half a day once you put the request in for the money to come back to your account.
Yep.
But yeah, they're all FDIC insured, just like your local bank is. Nothing different about them.
Yep. I-bonds, great question. We've had a lot of questions about these. On paper, it is the biggest, I don't want to call it a scam, but it's the biggest eye catcher that the federal government has that is not actually that great. The way an I-bond, it's a 25-year bond.
I'm pulling it up right now.
Yeah, it's a 25-year bond that for the first 6 months pays, I think, somewhere close to like 9%. And the interest rate that the bond is paying is based on what the interest rate environment is like. So right now, an I-bond is fantastic, but over 25 years, realistically, you'll probably be getting about 2 or 3% for 25 years. So I'm not a big fan. We are not big fans of you get 9% for 6 months. and then it drops dramatically based on the interest rate environment. That's number one. Number two, if you come out of the bond early or before 5 years, you forfeit some or all of the interest that you've earned. So, you might say, wow, 9%, even for 6 months, 9% is fantastic. Well, if you come out of it in 6 months, you forfeit most of the interest that you got over that 6 months. You have to hold the bond for at least 5 years in order to keep all of the interest that you've earned. And so, again, on paper, it sounds and looks fantastic. In practice, not really, because over a 25-year span, interest rates are not going to be high the whole time, and you're going to be stuck with the bond paying you 1 or 2% for 25 years. So again, sounds great, but in practice, it's just not.
And I think I'm looking right now, but I believe, if my memory is correct, Sam, that you can only put like $1,000.
10,000.
Yeah, it's very limited. So you get a great rate for 6 months. And then if you go to the government's website and, kind of Google I-bonds,
30 years, I'm sorry.
it shows you the history of the I-bond. And for the last probably 20 years, once you get past that 6-month high interest rate, they're paying nothing. I mean, when I say nothing, I mean literally zero. So to lock up 10 grand for 5 or 6 years, if they're going to pay 9% for 6 months and nothing after that,
it's pretty weak.
You're getting about a 2% return.
Yeah.
Have we ever had dealt with local government bonds or muni bonds? Had a friend say he was doing great with these. I'm just not familiar with it. All right, what a bond is, first of all, and you probably already know this, the bond is a loan. And so when you get do a government bond or a municipal bond, a local government, a town, a municipality is borrowing money for a project. And what makes them attractive is they may go, hey, we've got a 7-year bond. We'll pay you a guaranteed 5% interest rate. And the reason why people like them is because typically they're non-taxable, both state and federal, depending upon what it is.
And they're secured because they're backed by the financial security of.
Unless you're in San Francisco or California. I mean, one of the big things that happened several years ago was San Francisco that followed on their municipal bonds. I have not seen any bad muni bonds recently. I haven't seen any great ones either. I mean, I think what makes them appealing and that people like is, well, I can get 5% for 4 years and I don't have to pay taxes on it. So I would actually consider those more of a alternative to money market, probably, as opposed to a good, strong growth investment.
Yeah, I'm not sure what they're paying nowadays with the interest rate environment.
It's different. I mean, it depends on how long they're going to hold the money and
what kind of project. That's
and the same kind of thing. If it's a 5-year bond, and you want to come out in less than 5 years, you've got to find somebody that will buy the bond. And so what makes it difficult right now is, okay, let's say the bonds, I'm just picking a number, 5%, and the Fed's raised the interest rate again. And so the new bonds are 6.5%. Nobody's going to buy a 5% bond. So you're kind of stuck with it. Not necessarily a bad investment, but I wouldn't call it a growth investment. I would call it kind of a conservative, kind of a money market style investment.
Yep.
And we just had a client tell us he may be retiring. I'm stunned and awed, and this particular person is a workaholic, so I may need to go to church because I think Revelations is that one. Congratulations if you do retire. People are there. Amazing. What is it? What that will show? All right, any other questions? Oh. Yeah,
exactly.
Yeah, somebody just made a great comment. Take away Pearl, hold steady the money currently invested and add to banks that offer rates.
That's it.
Again, again, this is going to sound like we're trying to stock our own pockets, but we don't recommend keeping more than $20,000 or $30,000 in cash. Right now, if you've got substantial assets in the bank, as bad as it sounds, they should go in the market because the market is down now and it's going to come back up. But whatever you do keep in a bank, I would certainly look at those online bank accounts because they are far exceeding anything you'll find locally. And it goes back to expenses again. They have very little expenses.
No expenses.
Yeah,
actually.
really. Yeah, they really don't expense. They have the electronic aspect. So yeah.
So, all right. I think we will call it here. Thank y'all so much for joining us tonight, for taking a little bit of time out of your evening.
Oh, sorry.
Oh, hold on.
Yes, those of you, great question. Those of you that are retired and that we have been handling your stuff, I don't know of anybody that can't stay retired. Lucky, good, whatever. In 39 years, I've never had somebody that had to go back to work. And I'm not going to start now. The person that asked this question, you are so far ahead of the curve, it's not even funny. I don't anticipate any financial event happening that would make you have to go back to work. Those of you that are retired, we don't have any people that we're concerned about that, gee, they may have to go back to work. So you're good to go. Don't worry about it. You got plenty of assets, plenty of money in play. You ain't going back to work unless you want to.
And we can prove it if you're worried about it.
If you want to come talk to us, HH, we'll be glad to talk to you about it shortly.
Yep, give us a call. We'll prove it to you.
But you're in good shape.
Yep. So, all right.
Anything else?
I think that's it. Thank y'all so much for your time. Thanks for spending a little bit of time with us.
Okay, I have to ask a question. The last person that asked us, is your bride doing the happy dance because you may be retiring or because she ain't got to go back to work? I'm curious about that. I think if I told my wife I was retiring, she would not be doing the happy dance. Thank y'all for your time tonight. Have a great evening.
Yep. Thank y'all.
Yeah. Okay.